Well, hello everyone, and welcome very much to this industry-wide industry and client webinar. Excuse me. We've got a great panel assembled here. When I look across my view here, Andrew Rhodes is the head of our trading division. He's been with MCT since 2005. Paul Yarbrough has been in the industry since 2002 and with MCT since 2015. Justin Grant has been with MCT since 2006 and heads our investor services group. Paul, of course, heads our data analytics and client success group. And then we have the one and only Phil Rasori, one of the owners of MCT, who's been in the industry, gosh, since early 2000. So we're going to jump right in. We've got hundreds of folks on the line here, and there's a lot of information to cover. As always, we'll be providing a follow-up with this information and slide deck and to everybody that registered. And so with that, I'll pass it over to Phil Rasori.
Well, thanks, Chris. Appreciate the opening there, and appreciate everyone for joining our call here. This is our industry volatility webinar. There's a lot of clients on the line. Obviously, as with other industry webinars, some of this is going to be review because you guys, obviously, we've done prior webinars during this volatility period, and obviously you're going to hear some of this again from the market flashes, some of these recommendations that you've received in the market flashes. But we do have a lot to cover, so we're going to get right into it. We're going to first have Andrew go over a market overview and analysis of kind of where we've come since a couple days before quote unquote Liberation Day up until now, and then we will compare and contrast that substantial volatility that we saw in that period, because remember, we're a little smooth sailing now today versus where we were let's call it just under 2 weeks ago. But there were a lot of comparisons, especially in our market of fixed income starting to trade like risk assets for a little period of time there. There were a lot of comparisons made to COVID and prior market disconnects as well. So we're going to go over some compare and contrast that. Then Justin's going to take us through some loan trading considerations, just what we're seeing out there from an execution standpoint, recommendations that we have. Andrew and Justin will take us through some recommendations on TBA trading. Like Justin says, it wouldn't be a MCT webinar if we don't talk a little bit about AOT, but especially in times of volatility, you can see those bid offer spreads widen out just from a liquidity standpoint. And so, so there's some trading considerations to be taken into account there. And then we've got some pipeline management recommendations that Paul Yarbrough will go over using some of the tools that we have in MCT Live. And then Chris Anderson will go over pricing recommendations, lock desk recommendations, which of course are critical during this period of volatility, because that of course is where you're taking on the risk. That's where you're pricing your risk, which is pricing that short position, that interest rate lock commitment, or I should say the long position, pricing that in effect put option that you're giving to that borrower, right? And that becomes a more expensive proposition during times of volatility. And then we'll kind of round us out with some functionality to protect performance. But if we go to the next slide, we're gonna go ahead and actually, I'm sorry, I just kind of went over the rationale. So we're going to kick it to Andrew here for the market overview and analysis. Andrew, if you want to kind of give us an overview of where we've gone from a market standpoint, and maybe talk a little bit about how mortgages have performed, that would be great.
Yeah, thanks, Phil. So I guess just over the last couple days, I've been looking at it going back to April 1st on kind of just the volatility in the TBA market. And, it's really, I think there was a point in time where we were trading, above par on the 5.5. So I was kind of keeping an eye on that as the kind of par coupon. But if we go to the next slide, we'll see that right here, this is a graph from Bloomberg that just shows your kind of the interpolated par rate from Bloomberg compared to the 10-year Treasury, so kind of the mortgage to Treasury spread. And something that we've been keeping an eye on in terms of kind of the volatility in the market, just to see the difference between the two, to see if there's any systemic issues coming down the line, to see if there's anything that's going to be breaking. As you can see on the 9th, there was a huge swing in overall spread. At the lows, it was close to 120, and at the highs, it was close to right around 155. So that spread right there is a huge intraday move, looking at just straight pricing from a rate perspective. So that differential is from a rate perspective. So I know we like to look at it from a 4-to-1 multiple, so about 200 basis points in kind of pricing move. And what was interesting for everybody that was keeping an eye on the market that day is that there was a huge, or there's just been huge swings in this past week. So we've seen, I think on that day it was a 2-point swing in the market. I think another day we saw close to a point swing in the market. So, this is something that we're trying to, keep our eyes on, talk to our lenders about, and making sure that we're all on the same page in terms of kind of how they're managing the inflows and how they're, coordinating on their loan sales when they're going to market. So I think going on to the next slide, we'll take a look at this is some of that intraday volatility that I was talking about. As you could see, prior to last week, we were trading just above par on the 5.5s, and now I think with a little bit of a bounce that we've gotten today, we're sitting right in the mid 98s. So I think hopefully we'll continue to see a bounce and get back up to that par level, but I think for the time being, given the uncertainty that's happening, we just want to keep an eye on all the relative volatility that's happening to make sure we're aware of kind of how the mortgages are going to be performing. So if we go to the last slide here before I hand it back to Phil, I just wanted to kind of take a look at the par rate compared to the key economic events that have happened going back to 2007. So the reason I kind of wanted to display this was just to tell everybody that it's unfortunate, but these are these are things that we've been through over the years. So if you've been in the industry, it'll be 20 years for me this year. We've seen a lot happen, and we've weathered a lot of different turmoil. And I think this just kind of highlights everything that we've been through and everything that we've kind of gone through, all the different types of volatility. Not to say that this is going to be the same kind of volatility as what we've seen in the past, but it definitely helps us have proper recommendations and have proper discussions with clients on how to manage their risk over this time of volatility. So with that, Phil, I think I'm going to hand it back to you for next section.
Thank you, Andrew. That was great market overview there. And what we want to do is kind of like I had said at the outset, compare and contrast a little bit of what we've seen over the past couple of weeks versus previous market disconnects. And again, the closest and most present one in all of our minds is March of or I should say specifically second and third week of March of 2020. So we'll take a look at that. You can see here that when we look at the spread to treasuries, that was, Andrew's graph earlier showed some real wobbling. I think that was the Thursday after I want to say that was the Thursday after the tariffs were announced. We saw this, this shoot up in spread to treasuries, and that was a very concerning time where that's when we began to shoot out communications to all of you clients on the line here. You can see here the movement spread to treasuries. It was a lot bigger, right? In the third week of March, you truly had mortgages trading like risk assets. There was, you talking to market participants, to dealers in the industry, you were starting to see quote unquote cracks in the mortgage market. And that's of course when the Fed came in of that third week or third or fourth week of March of 2020 and really came in with their bazooka and basically said, we're going to buy whatever it takes. And that's when you saw the spread come right back down in line, and it was needed to support. So as Andrew's previous graph had shown, we really haven't gotten there yet, and obviously, hopefully, we will not get there. But that's definitely a key difference. And then if we move to look at the kind of the execution kind of breakage that occurred with aggregator execution and agency execution, we saw a big disconnect, right? And that was severely problematic in those period in that couple week period of March 2020, because of course the dramatic rally had caused severe negative positions in for the hedge positions, and then the locked loan pipelines were not following. So that was definitely a big there were some big disconnects. And what we're seeing now is a lot different. And so if we can go to the next slide and just kind of summarize the similarities, we have a multiple standard deviation intraday price movement in equity markets. There's no question that there was a lot of similarities between equity price movements. There was macroeconomic movements, macroeconomic externalities that were pushing, and still are to this day, to today, right? Pushing treasuries and TBAs to move a little bit more like risk assets, where you'll see I know we're not seeing it as much today, but you'll see a peel off of the equity markets, and then you'll unfortunately for all of us, we don't see the general inverse correlation with the bond market, right? That flight to safety isn't there. So that definitely is, or the flight to safety, I should say, is not there yet in the U.S. markets. It may be, as we've seen, a little bit of deterioration in the dollar. And as you guys watch on Bloomberg and CNBC, you're hearing talk about a flight to safety elsewhere. And so that is that's very similar to what we've seen previously in times like COVID. The difference is, like I'd said earlier, and Andrew's slide had shown, we're seeing a relatively consistent spread to treasuries, so that's a really good thing. But most importantly, I wanted to focus on the second bullet point here, that it may not look like it to when you look at the surveys out there that currently exist in the market, but mortgage secondary execution has performed very well during this period. And you guys might, a lot of you on the line might hear me say that and kind of think that statement is inconsistent with what you've seen out there in the market. And the bottom line is, it's important to understand that, especially during periods of volatility, a kind of those legacy rate surveys that you see out there that will survey a best effort conglomeration of best effort rate sheets, and what's being pushed out to the street, those are not going to be a good indicator of where mortgage execution is. And the reason is, as you lenders on the line know, you're taking on risk as you extend this interest rate lock commitment to the borrower. That put option, the risk of that put option, you being the writer of that interest rate lock commitment, you're taking on a larger amount of risk as volatility increases. And therefore, as we've been recommending to, again, the lenders, client lenders on the line for the past 2 weeks, you've been putting additional margin into those rate sheets. That's the same way on the best effort side. And so we've seen, as we've seen some best effort rate sheets go, Chris Anderson has a lot of good data on this that he's going to show you later as he shows you, huge disparate moves, investor to investor, aggregator to an aggregator. But the bottom line is that to accurately analyze the secondary execution, you've got to take a look at your back end execution and analyze the back end execution of closed loan collateral. And I'm really excited to announce that Andrew and Justin and Paul, they will be working to produce a back end execution indice that we're looking to release in May in national secondary. But as a kind of a prelude to that, I wanted to have Justin, if you could go through what we're seeing out there from a back end execution perspective that might differ a little bit from what you see from a rate lock survey or a rate survey on the front end.
Yeah, thanks, Phil. If we head to the next slide there. Just like Phil was saying, huge differences between COVID and then those who were around 2013, I think, taper tantrum period we went through, where just massive dislocations between kind of end aggregator pricing, aggregator and agency direct pricing versus those underlying TBAs that most of you are hedging, hedging the pipelines with. What you're seeing right now, just an example of, at MCT, through our MCT marketplace, we have tons of lenders transacting every day. So we're getting a good cross section, able to see those end execution points relative to the underlying securities that they're slotting through, and controlling for things like loan level price adjustments, some of the other factors that are going through pricing, right? We can see how that execution is either faded or improved over time. And so this is just one scenario. Andrew had that graph that he showed of the UM 5.5 coupon, which was, by and large, a lot of production was getting slotted there as the par coupon before the sell-off. And now many of you have, roughly, 2 points of degradation in that security before today. What you're seeing here is you're actually seeing end pricing holding that security constant, holding steady, and even rallying a little bit. You look back, a week or so ago, we had market open down a couple percent, S&P 500, and then end up rallying to close the day. We're actually seeing that end investor execution improve, and that's what you would expect to see outside of any crazy volatility, right? As rates are increasing, all things being equal, existing loans that are in the pipeline, you now have lower rates, par rate is going up, so servicing values are increasing. So that's what you want to see, right? Is you should actually see a slight increase in end investor execution to account for that improvement in servicing values. And that's exactly what we're seeing here versus COVID, where you had servicing values disappear completely on top of investors throwing in margins. You'd actually, if we would have plotted this out, you'd be seeing a line that's going from the upper left to the lower right, meaning you're losing value in your end execution. So like Phil said, a lot more to come on this, which is super exciting. But I think so far, hats off to the aggregator community out there. who again are really hung in there price wise. So if you want to go to the next slide, yeah, maybe the next one. So just kind of go into a couple considerations, some additional things we're seeing. We're that last slide when we're kind of showing a sample index there of certain security. This graph, in hindsight, many of you out there, including MCT clients, are looking at a lot of different executions. You might be sending out 10 to 30 bids to investors, and then also looking at a multitude of agency executions, whether you're retaining and also looking at co-issue. The point is you're going to get gyrations in pricing, right? There will be some folks that pull back, others that step in. So, the idea being, it's still really important to make sure that you've got a lot of executions in your tool belt, right? A myriad of investors to be looking at, but also if you have the ability to get that agency approval, even if you're retaining servicing, you want to be looking at co-issue executions as well. You know, having, I guess the old stock market saying is diversification is the only free lunch, right? And the same is true from secondary execution standpoint. The more investors that you've got and that you can look at, the greater the chance that your end P&L is less affected. So, our clients know, through our MCT marketplace, um, make it super easy for you to be looking at a multitude of executions. If you go to that next slide, Ian, we'll kind of look at some co-issue pricing that we've seen over the last week here. Again, I think obviously some movement, but if you look at a lot of those folks outside of the investor in the blue graph there, right? You've seen throughout all this volatility, co-issue values holding, very steady, very competitive market. So again, you want to be making sure you're looking at a lot of executions on the co-issue side. If you do have that agency approval, we have our co-issue marketplace here at MCT, and one of the things we found over the last couple of years, we had a lot of clients sending out bids to 20 or so aggregators. But if they had their agency approval, they might be selling to one co-issue investor or two co-issue investors. And if you just think of um, the fact of how you don't even have to deal with stips and everything when you're selling to the agencies. It just makes no sense to not be looking at just about everybody in there, so that you are well diversified, and at least worst case, validating that if you're not executing there, at least you know where your execution is relative to where others are going to buy it. So again, super. And obviously, Freddie Cash Release Exchange, CIX, and Fannie Servicing Marketplace. The agencies, hats off to them. They do a great job of making that easy for you as lenders, to have access to those executions. So really encourage you to make sure that you're diversified from that standpoint as well. Go to the next slide there. Phil mentioned earlier, we wouldn't be an MCT webinar without covering AOT. And what you're looking at here, and Andrew will talk a little bit about this as well, but obviously in periods of volatility, and especially since the Fed has been out the last couple of years supporting the market, we've just seen elevated bid-ask spreads. Even before this volatility. And then, if you look for the month of April, we're averaging over 4 ticks. So what you're seeing here is just, these are all clients on our platform that are doing assignments. And actually we did a similar webinar for our clients last week. And that number was even lower. So even just in the last couple trading days, we've seen the spreads, still continue to widen out. So, really important for those of you, that have the investors, the end executions that are offering AOT. If you're selling to those investors and not assigning trades, there's really no reason not to, because you're going to save, looking at this month, four ticks on average just from that bid ask spread. Right? Because if you're not assigning that trade, you're then most likely gonna have to go in and pair out of that hedge, and incurring that wide bid offer spread. So just it's already a no-brainer to be doing that, in periods where there's not volatility. But certainly, you're talking real money here that's being left on the table, and it's a great way to manage cash flows when you get huge market gyrations from day to day. You're kind of wrapping in the trade gain or loss into the price of the loan, which from an accounting standpoint, I know a lot of folks like as well. So, if you're on MCT Marketplace, we obviously make that automatic for you, for your sellers on there, that, when you're going throughout the course of your loan sale, that's coming up, and you're able to see automatically those trades that you can assign, eligible trades that you can assign to your investors. So definitely encourage you guys to continue to do so. Go to the next slide here. So just a few takeaways. Obviously diversification is the only free lunch. Again, it's so easy to platforms like ours to view and incorporate a multitude of investor executions into your best X. Really, it's the easiest and best way to ensure that you're gonna minimize that any degradation in secondary execution. Some of these investors more so on the best effort side, but even mandatory, they're going to come in day out, also to protect themselves from the volatility. So any given day, an investor can be pricing better than others. So really important to be taking a look at as many investors as you can, and then communicate with your investors. I think the biggest thing when we're talking wide bid-ask spreads, market spots, the market's just moving quickly. Pay attention to your market spots. If you happen to be committing, during a volatile period of time, a lot of the investors, right, they're handling a lot of bids, especially if they're delayed and getting a confirmation back. We all know that's going to happen. Pay attention. There could easily struck it when the spreads happen to widen out, and be really artificially wide. You just want to tighten up and make sure you're looking at everything there, just to make sure everything's in line. Because again, those wider bid-ask spreads, can negatively impact that final commitment strike price. So make sure you're paying attention there, communicating with your investors, leveraging those assignments. And then the other thing, when you're doing those sales with the market spots, you just want to keep an eye on where those are at. Try to avoid committing when we know that there's going to be a news announcement. I know we're going to get a lot of times where there's going to be breaking news that we have no control over, but whether you're trading around key data releases or Fed announcements, make sure your loan sales are done with plenty of time to adjust your position, so you don't get caught up in committing loans and all of a sudden the markets start to gyrate, because all that'll have a negative effect on your P&L. So pretty simple. A lot of you, this is basics, but again, it's good to refresh our memories when we do get market shots like this. So that's it for me.
Yeah, and I think just to kind of step in here, Justin, is to really highlight that these are good practices to do on a regular basis, right? is like times of volatility is definitely, you need to pay close attention to it, but I think it's a good thing to pay attention to all the time, right? So I'm talking to the traders last week. I gave them a heads up. I was like, hey, we have the 10-year auction coming out, 10 o'clock Pacific. Make sure all your loan sales and trading is wrapped up by 9:30. That way you don't get caught up in the mix. So I think, as Justin was kind of highlighting, I think it's a great thing to do all the time, but definitely, in times of volatility, it really kind of brings it to everybody's attention a lot more, but it should be part of the daily practice, really. So from my perspective, just kind of going into some TBA recommendations, this is all good to kind of do on a regular basis as well. When you see, a lot of production coming in, you want to make sure that you're trading your TBAs kind of in line with that production coming in, and that's a great way to kind of manage your margin and making sure that your front end pricing is kind of set in line with where those TBAs are going to be put on, because that will kind of reduce some of the leakage that you'll get out of the hedge side by matching up the incoming locks with the TBA production. So I think, talking about AOTs, it is a great way to kind of manage the cash flow. Justin was talking about that earlier, and I think, just to kind of have it all flow together, right? The benefit of doing an AOT is you're kind of locking in that price with the investors. So you're also mitigating a lot of that volatility, intraday volatility, by doing the assignment, because you're using the strike price of the TBA that you already have on as the kind of the underlying price of your loan collateral being delivered to the investors. So it really does streamline the whole cash flow, and it does reduce the volatility, as well as kind of allowing you to set out future hedges with incoming production to match up with your expiration. So a lot of benefits there, but it is something that you guys should be taking advantage of as much as possible, and working with those dealers and investors that have those relationships set up. One thing that one of the traders came up to me with last week was just like, hey, I've been noticing that rolls are actually really beneficial right now in this market. So that is something to keep in mind. If you are short or long, and you need to kind of change your position up, a good way to do that is by doing a roll with some production that you have that might not be assignable at that point in time. So, right now we're already through Class A, coming up on Class C, but let's just say you still had some Class C out in April, which I hope nobody does. You would essentially roll that position out to, you could add or remove from that position when you're rolling it, and you'll get an economic pickup by doing that way, instead of having to pair out of it and then reset a position out in a future month. So it is a cost-effective way to manage the trading side of it. So I think from there we'll kind of step into some, before we go on to that, looking at the bid-ask spread. So this is something that, if we're going back to when the Fed was in the market, it was definitely a lot tighter. As soon as the Fed took a step back, we've definitely seen this widen out, and this just goes to highlight the need to stay on top of your options to compress that bid-ask spread. So you could do that by assigning, essentially removing that bid-ask spread. But then you also want to make sure that you're getting the best price for the trades that you're putting on when you're doing this, by getting that out to multiple execution options. So looking at multiple dealers when you're setting up your hedge position is a great way to kind of mitigate that and just get reduce the volatility that you're seeing in that price. And kind of like I said earlier, just another way to help manage that margin with the incoming production. If we want to go to the next slides here, so I'll kind of take a step into some of the pipeline management essentials. So these are going back to I was looking at a couple slide decks from prior webinars, and it really is consistent. Something that we go through all the time, blocking and tackling. Getting back to the basics. You want to make sure you're looking at your pull through. You want to make sure that you're staying close to optimal, and something that Chris will talk about here in a minute in terms of managing your front end pricing. You want to make sure that you're mitigating your exposure on that as much as possible. So you want to make sure that, in times of high volatility like this, that you're looking at the standard products, the standard note rates, anything on the fringe, you want to make sure you're building in some higher margin for if you are planning on bringing those in. Another thing that I talk to all the traders about is matching up your coupons to your incoming production. This is a great way to remove a lot of basis risk from the hedge, and by doing that, you're also setting yourself up for allocations down the line in terms of kind of maximizing that P&L. So, when we're looking at setting up that margin, we also want to make sure that we're looking at overnight or after hours locks coming through. So as much as possible, we want to put in additional margin to manage those after hour locks, or setting up a threshold on what your allowance is to take after hours to ensure that you're still within your optimal coverage or within your threshold for your optimal coverage. So it's a lot different for pipelines of different sizes, but it really is important to limit that as much as possible. Just given the news that comes out overnight, we don't know what's gonna happen. We don't know if there's gonna be some news that comes out that will shake the market up. So we want to limit that as much as possible during these times. And then the last bullet point here I think is important. There's going to be a lot of volatility. There's going to be some conditional fallout from the volatility, and you want to keep a close eye on it, but you want to make sure that you're not being too reactive on that as well, right? So if you're seeing a lot of fallout, you don't want to go ahead and change your underlying assumptions to match that fallout, unless it's something foundational. If it's something from a lock desk policy change, or if you bring in new branches, then that would be a reason for changes in the kind of the underlying. But outside of that, just keep a close eye on your pull through. Make sure you're managing to those to your levels and to your fallout, based off the last kind of review that you did prior to hitting these uncertain times. And then I think with that, I think we're going over to Chris. Is that the next slide?
I think Paul might be jumping in there. Is that right?
Oh.
Well, either one of us will go. We'll just take that next slide, though.
Thank you, Chris.
Ian, if you want to just advance to that next slide, if you could, that would be great. If not, we can work through it. I was actually going to mention this earlier. I wanted to apologize for my introduction being a little choppy. For those of you who are located in the San Diego area, we had a little excitement going on. There was anywhere from a 5.1 to 6.7 earthquake near Andrew's house. Actually, I think, Andrew, you were shaking a little bit. And I actually happened to be getting texted from all of our division heads reporting everybody was okay right at the top of the hour here. All right, Ian's experiencing an internet issue, guys. So let me pull up the slide here. And Paul, why don't you start talking to it, and I'll jump in here. I just need to get logged into my email. Are we able to hear Paul? Oh, nope.
Yeah, a little technical difficulty with the mute button. I'm sure we've all experienced that in the last 5 years. But what we're going to talk about next is some originator pricing and some how to manage your rate sheets and some of the stuff we saw as far as patterns over the last week in pricing changes. I think it's very important to manage your originator expectations, right? If your rate sheets are delayed, just keep that in mind. Like, not only are your rate sheets delayed, but probably the investors or even the source of that pricing is so volatile, to set a benchmark to base that rate sheet becomes an issue. So I think in my experience, prior to my MCT life, I was with a few originators. In my experience, just being honest and saying, yeah, we're delayed because of this. It's not the best of circumstances, but just managing those expectations, like with anything, goes a long way with your originators. And giving yourself room and overnight. I know a lot of folks are kind of forced to, support an overnight price protection, maybe overnight lock. So if you are one of those originators that does that, just be cognizant that a lot of the market volatility was occurring as the Asian markets opened. I know the group on the line here, we were on a constant text stream throughout the night as the Asian markets opened, because we saw a huge volatility in the 10-year and then ultimately what passed through to those mortgages the next day. So protect yourself there. If you're not putting in margin with your after-hour locks, do so, or
Well,
at least.
I think now I've managed to get this right. I apologize here.
Yeah.
I'll jump back in. I guess your section is a little bit later there. My apologies there.
Yeah,
so
all good.
But look, you guys have an amazing guy in Paul to begin with. So are you guys able to see my screen? Not quite yet, right?
Yeah, we got you, Chris.
We got you.
Gotcha. All right. So as as Paul was talking about, the main takeaways that we have before we dive into some specifics here on rate sheet and really originator pricing takeaways is, talk to your people. At MCT, look, we have salespeople that sometimes I love dearly and sometimes I want to strangle. But if you're open and, you really explain what's going on, I think folks are understanding. So Paul did a great job hitting on some of these, but I think I want to, and I'll actually show you a tool that a lot of our sophisticated clients at MCT are using to actually kind of control the amount of spec they're passing on. I'll show you that in a moment. But the other thing I want to be sure everybody is doing is making full use of their mortgage technology stack. And whether you're managing your pricing within an all-in-one LOS and pricing engine or a separate pricing engine, you really want to make sure that you're using every tool possible. I've actually been looking a lot. Mortec has a little email that goes out that kind of summarizes, rate sheet to rate sheet changes. I'm sure a lot of the different groups have them out there. One of the other things I wanted to mention at the onset of our presentation was actually that a lot of our clients appreciate these client webinars that we have, and then a lot of our vendor partners encourage us, and we're happy to step up wherever possible to bring this information that we're sharing out to the industry as a whole. Clearly, we have some specificity for MCT clients and how we handle things, but in general, a lot of what we're covering is kind of no-brainer information here. But it's always good to reinforce, and like I said, just talk to your folks about rate sheets. I think that has some real, applicability to the lock desk as well. But just kind of want to give everybody an idea. We've been tracking rate sheet pricing very closely. And so this is best effort rate sheet pricing. You can see that, here we came out Friday before we had any news. There was actually some rate sheet improvement in pricing from the last market price on Thursday to the morning of Friday. And then you can see that sort of track steadily down. We had that big jump on the Wednesday where we had overnight issues there, and now Monday morning we're starting to see that pricing come back. Again, we all know that, as Andrew was saying, pricing isn't directly related to rate, but I think as we've seen a good 200 basis points in swing, we've seen probably about a half point in rate. This was another really interesting, look at this. You can see the volatility, and we're looking at Con 1530 and government 30-year production here, but you can see this price volatility. And again, the reason why we want to be looking at all of this price volatility is, okay, if we're setting our rate sheet pricing, how do we protect ourselves? Well, it goes back to what Justin was saying there. We've got to diversify all of our executions as much as possible. This was an observation that I had just looking back from Friday to Friday. I sourced all of this from kind of the top 12 most relevant investors. And you can see, look, some investors are pricing 3 times a day where others are only pricing once. Some are pricing twice or 4 times. And what that means is that in all likelihood, the next morning, if you've only priced twice in one day and your competitor or your other market participants have priced 3 or 4 times, you're probably going to have a larger swing. So as we're trying to guess that margin, how much margin, as Andrew was talking about, that we need to bake in to protect ourselves from overnight moves, it really matters who your investors are. Here we're just looking at Con 15s, and let's just pull out, some differences here. I mean, hey, you might see 28 basis points, you might see 55 basis points, right? You might see 86 basis points or only 20 basis points. So if you only have, a few number of these in investors and you're piling them into your best X for your rate sheets, that's going to really cause some issues. Same thing with 30-year. If you were looking at conventional 30-year, you got some guys that are 20 basis points, some that are 110 basis points. Again, if you go back, in all likelihood, the prior day there were more reprices. But again, that's something you've got to, you have to kind of protect against. So again, as Paul was saying and covering for me, which I appreciate again, Paul, we can see this, there's some benefit, especially as you see aggregators who are all doing the same thing. There's nothing wrong with what they're doing. They're trying to protect themselves just as well as the lenders that are our clients and are out in the industry are trying to protect themselves as well. And it's a necessity. But if at any point in time you were going to hold your rate sheet production, here's one to do it. The other thing is, if you're using aggregators and you're using only aggregators to best X, you're going to have delays to begin with, because the aggregators are needing to delay to really kind of wait till they get some market stability. So a lot of our clients that are agency approved use what we call our base rate generator or dynamic pricing tool set to kind of follow their agency executions, and you can blend in all of those co-issue agency executions as well. And one of the things that that is really important, whether you're using just the agencies or you're using aggregators that pass on spec, this is just a screenshot here from our base rate generator or dynamic pricing tool. We allow you to build rules, and you can have an absolute rule, you can have a percentage holdback, but the idea here is, especially in these volatile times, you do not want to be pushing 100% of your spec pay up through to the front end originator pricing. And this is a shameless plug for our Atlas AI tool, because I always say, hey, I always want people instead of AI. And here's a perfect example where I couldn't remember, do I enter this? You can differentiate by execution here. So like I said, you could do an absolute holdback, a percentage holdback, or you could say, hey, base price to spec price, if I get 1.5 in improvement, then below that threshold, I want to take out only 35 basis points. Above that threshold, I want to hold back 65 basis points. I couldn't remember how to enter that as a price or just the 1.5. And sure enough, our Atlas AI tool did it for me there. So Phil, hats off to you on that one. Did anybody want to jump in on anything there? I know we had some technical difficulties there, but anybody from the team want to share anything? All good? All right, so on our lock desk, we have an outsourced lock desk here at MCT, so we're able to see quite a few different lenders and how they operate. And then we're locking loans with all of the investors and interacting with their lock desks as well. So again, just like when you're managing expectations around rate sheet pricing, it's really important that you manage expectations around lock desk operations. Lock desk operations, look, you may have several hundred originators and you've got 2 or 3 guys on the lock desk. Everybody dumps in all of their locks, there's going to be an issue. And I know a lot of folks are using auto lock in their pricing engines, and that's something that you really need to be sure the pricing engines are updating pricing from those new rate sheets. If an investor is issuing 3, 4, 5 rate sheets a day, are you getting stuck when that price is expired, but the new rate sheet isn't in the pricing engine? So we talk about adding market or adding margin at the end of the day. I really like the idea of constantly using your PPE to keep an eye out for an opportunity to use intraday, temporary adverse market movement adjustments. They're hidden, but you can build them in to just protect yourself during those reprices. The other thing is, if you don't have what's called an emergency circuit breaker contained in your lock desk policies and procedures, you definitely want to include it there. And you want to educate your loan officers on that, not just now in the time of market volatility, but in the onboarding of every new loan officer that brings on. Make sure they understand that, look, in some cases, there's going to be so much market movement. I mean, think back to what we were looking at overnight. There were some market investors that came out 100 basis points less than they had been that prior afternoon, right? And in those cases, you have to have the ability to adjust your lock desk hours. And I think right now, I just wouldn't recommend keeping my lock desk open over the weekend at all. And really, even after hours is a big gamut unless you're really pulling those margins in. And again, some investors are at 50, some are at 100, some are at 20. You really need to be conservative there. So, out here on the West Coast, the market closes at 2 p.m. Pacific. So normally you can accommodate that by adjusting your hedging, your position with your trader, knowing that, hey, historically we see, 12, 20 locks come in, and you can adjust for that somewhat, right? But if you don't have the ability to really predict what lock rates are, how many locks are coming in, right now it might be a good idea from, say 2 to, let's say your lock desk is open till 5, maybe from 2 to 5 after the market is closed, you consider locking some of that production best effort. But if you're hedging with MCT or hedging with anybody else, you must communicate all day, every day with your trade team, or if you're running your trading yourself, really be talking to that lock desk. Make sure you understand that, those locks are coming in, and if they get backed up on locks, and that you're the kind of lender that's probably going to approve those locks coming in regardless, or maybe you're auto locking them, you just want to keep on that. In our tool, Lock Desk Live, that we use to run our lock desk, we've actually built out a report that kind of explains, what information you really need to see in those pending locks. And here's a view from MCT Live of our daily locked volume, and just how much, how much different you can see. If you jump from, this is in millions, I think here, but you can see there's a pretty dramatic jump in this last week. And here, if I take it down to a little bit restricted view of just one team in the lock desk, you can see that, hey, they're trailing along around 750 locks, and then all of a sudden they're jumping up to, almost, an extra 300 or 400 locks. Look, that's, if you've got just a couple of people working the lock desk, that can be pretty significant. And so I think I'll just take a moment there to recenter, make sure, Paul, are you seeing everything okay? I'm going to bring the slides back up, but are we all good? Anybody want to add anything there? All right, well, look, we saved the best for last. Number one, he's the most good-looking guy here, but I'll pass it, except for Phil, I should say, but I'll pass that over to you, Paul, and just let me know when you'd like me to advance. So were you seeing key software functionality right now?
Sure, thank you, Chris. Yeah, so, great piggybacking here, or segue, I should say, with from Chris's topic of the locks coming in fast and furious. We saw a huge spike as the market rebounded, and it makes sense, right? Like as we were going in post Liberation Day there, market was rallying. Probably a lot of quotes went out over the weekend. Market sold off, and then got a little reprieve and a bounce back, and just saw a huge spike in locks. Well, what we're showing here, as this is just a good tool that we have inside of MCT Live, our platform, but regardless if you're using MCT Live or not, just making sure that your margins are coming into the benchmarks that you expect to as you lock those requests from your LOs for the borrowers. They you should have certain goals in mind to say, okay, every conventional should come in at this, a govy, a jumbo, a non-QM. What are those expected initial margins as that loan is locked over the rate sheet pricing? And so as locks are coming in fast and furious, it's things can happen as we're trying to confirm those, so you can get those disclosures out as quickly as possible, and maybe some things get missed. So just using tools like this one where you can see I've got this kindergarten style circle around our benchmarks here, where it's just, these are the benchmarks that this particular sample would use. Maybe it's a best effort benchmark, maybe it's your cost of origination that you're benchmarking over. As these locks come into the pipeline, we can see here, what are they coming in at? So hopefully they're not like the third one down there at negative 212 basis points, but just a good example of what to look for as locks are coming in. And then I want to advance that next slide. Now what's happening is, Andrew mentioned this earlier on some of your pipeline movement, and he talked specifically about fallout and your pull through assumptions. What I like to remind folks is to keep your pipeline tight. And again, all these recommendations we're talking about are good for any market, right, regardless of volatility. If we just had the most boring, stable market, all these recommendations are good. But in times like this, if you're doing these fundamental things, then you're going to be set up for success in volatility like we've had here the last few weeks. So this tool specifically is showing price changes based on attribute changes. So credit score changes, LTV, loan amount. Loan amount's huge, right? Like it used to be back in the day where loan amount changed. The only thing that was really affected is probably the servicing release premium, that SRP. Maybe there was a loan level price adjustment related to loan amount from an aggregator, but it was all based on that servicing. Well, now loan amounts change, and then it can affect that base price because of the spec, right? So if you drop, or let's say you had a $149,000 loan amount and went to 151, right? So that can lower that base price for that loan. So it's important to pay attention to those attribute changes. We have a tool here called Pipeline Deltas that's going to give you the a price for both scenarios. Basically, if a DTI changed or FICO score or any of those others I mentioned before, then it'll give you a price before and after. The reason I mentioned pull through at the top of that and fallout is like a lot of times this can kind of lead to fallout. Let's say a credit score unfortunately dropped from the very optimistic 780 to maybe a 480. Hopefully you can still find a home for that borrower, but maybe it ends up being fallout. So keeping the pipeline tight, using this to not only price to pass through any kind of price changes if you're able to, but also to identify fallout maybe early if something becomes ineligible. And we'll go to the next slide here, Chris. And Justin mentioned too, as investors are confirming those prices, the market can spread out the time of their confirm, and it's important to keep that communication going with them and say, just double checking, are we good here? But then at the end of that process, you got to confirm. Now you've delivered the documents and the collateral, and it's ready to be purchased. Sometimes, as you all know, that there can be leaks within that purchase process. Maybe it's appropriate, maybe it took you a little longer to clear that step and you got a little extension fee on there, but maybe sometimes just something was missed in the bidding process and you're finding leakage. Either there was some data error from the LOS, or perhaps the investor just missed something there. And so just checking these leakage reports where you can come in and say, hey, I confirmed the bid at X, and then you bought it at Y, and there's a little difference there. Can we discover that? Taking care of those things sooner than later. You don't want to be caught in a market movement there or find out 60 days down the road that you've had a big drop in what you expected for those confirmation prices. And then we at MCT are hyper focused on obviously the hedged pipeline, but the best effort pipeline becomes very important as well, or is always very important. Doesn't become this, but it is very important just because, again, you can monitor those initial margins coming in, right? You take a best effort lock, somebody on your lock desk is flipping that over to the investor and taking down that best effort commitment, making sure those margins are coming in, monitoring your best effort pipeline obviously just as important as your hedged pipeline. You want to make sure that, like I said, margins are correct there when you take those locks down. And then also, like, if you've got loans that are held for sale that you're waiting to be purchased, are those shipping, is the collateral being shipped, or the documents being uploaded, are the STIPs getting cleared? You don't want to age best effort loans sitting out there, and then all of a sudden a lock that you took 90 days ago is you find this volatility, you're susceptible to this volatility, and the margins have widened out at the investors. You may be in a worst case scenario, and that's not good. So just keeping that, like I keep saying, keeping that pipeline tight, making sure everything is up to snuff there. There are tools in MCT Live as well where you can run individual mark-to-markets. Maybe we do have a spike in volatility or a spike in mortgage pricing rates coming down. Get renegotiation questions. You want to come in and price that loan against the current market to make sure the renegotiation is available or should be given, following your policies and procedures there. I realize right now, speaking about renegotiations probably sounds like a foreign concept, but if we started the planning of this series of webinars, we were in a time of rates are looking to go down quite a bit, and rates have obviously spiked back up here in the last couple of weeks, but that volatility is not done. So we could have that other side where renegotiations are coming into play. So having a tool where you can automatically best X loans against the current market, very important. Here we're just showing a place in our platform, MCT Live, where you can do that on a single loan. And then Chris, if you wanted to move to the next slide there, you can also just run your whole pipeline. So if we have, and this one, in this example, in the screenshot here, you have 890 loans. If you wanted to run that whole pipeline as an intraday mark-to-market, all good, you can fire that out. And then lastly, one of the things that we've noticed over the last, really it's been over the last year, as we've been in kind of some questionable economic times as far as the future of the economy. We've gone from an inverse yield curve to a steepening yield curve, and what within those movements, those major movements, we see the months also widening out and contracting. So right now, you're looking at May, June, July. In some instances, you may get out to August as well on your conventional TBAs. The spread between those months obviously tighten and widen out as well. What we have found is that it drives the need to best X not only a price from aggregator to agency to whoever you're selling your loans to, but also within the same investor, best Xing those delivery periods. So we have here some recent functionality that you can best X up to 8 delivery periods with your agencies. So we have some clients that like to do from all the way from 2 days to 45 days, just to make sure they're hitting that best one. And so it's a good tool just to ensure that, hey, I'm picking the best price. The good news is when you're delivering to Fannie Freddie, you take down a 12-day, you still want to hit that 2-day delivery window, you still get that best price, assuming that 12-day is the higher one. So hopefully that makes sense to everybody, but just keeping that in mind that you could possibly have a better price as a longer delivery. It's counterintuitive, but we've found that that can be the case sometimes. And then not to throw Chris under the bus, but we did in fact save the best for last, which was Phil Rasori, and so he'll wrap us up here.
Thank you, Paul, and thank you, Andrew, Justin, and Chris. That was a content-rich webinar, to say the least. Usually we run an hour webinar and maybe run over a couple minutes in about 7 slides. and I know we're over time here, but given we had 44 slides, I think that's pretty efficient. I'd say so. No, that was a lot of good, great information there. And look, just what to look for moving forward. Obviously, there's been been a little bit of a pause here outside of the China situation, but I think we can all agree volatility remains high. Some of the stuff Chris was talking about on the weekends, lock desk. I think that just given kind of communication patterns, what's happening, I think we can all agree that weekends are kind of almost as far as an information flow, almost like weekdays. Only problem is you don't have the ability to trade or to put on coverage. So I think definitely we'd definitely recommend to stay vigilant on the lock desk and pricing and coverage ratios. Be vigilant and prepared, as this says, for moving either direction. Like Paul said, we were getting ready for a pretty good rally before the 90-day pause. Now it looks like we're moving in the other direction, but you could really make the case either way. Definitely reach out to MCT team members. Obviously our clients, you guys on the line are definitely our top priority. But even if you aren't a client, I know you may know one of our team members and have a question. We'd be happy to help. And then specifically for MCT clients, just make sure that you're on our market flash communications. We like to save those for just critical times. Obviously, you've been seeing some of those the last couple of weeks. And, we, like we did last week, sometimes there's an immediate client webinar without a lot of notice. Hopefully we don't have a lot of those in the near future here. But we will kind of take the events as they come. And but in general, I want to thank everybody for being on the line, and we will if we continue to see market instability, we'll most likely have another one of these. But really appreciate everyone's time.